Welcome to the Remarkable Retail Podcast, Season 5, Episode 23, presented by Market Dial. I'm Michael LeBlanc.
And I'm Steve Dennis.
Well, Steve, we're celebrating a pretty big milestone with this episode, 100 regular feature episodes. Cue the applause. There we go.
Looks like we made it. Looks like we made it somehow or other.
Looks like we made it. That's right.
It's pretty crazy.
It's great. Oh, listen, this COVID project of ours and your partnership, I really do appreciate you and thank you for your support and partnership and all that great stuff. It's been fun.
Well, of course. Well, this thing, I think I may have mentioned this sometime along the way, but you were really the instigator. Even though I had this idea of doing a podcast, you were really the guy that got me off the fence and made it happen, and obviously have become a great partner through over 2 years now and 100 episodes. And it's been an interesting journey. I was listening to a couple of older episodes for various reasons. It was just interesting to see how the formats shifted a little bit, and I think our chemistry or whatever has developed, and I got a better mic now, and all those kinds of things. But I was also going back and just reviewing some of the episodes, and just got a couple fun facts I want to mention. It's a little self-indulgent, so listeners can skip ahead if they don't want to hear this. But
lay 'em down.
How many different CEOs or presidents do you think we've had on? So either of current or former retailers. But out of the 100 episodes, how many CEOs have we had on?
Geez, I never thought of it that way. I got to think we're the majority. I mean, pretty much the vast majority. What's the number?
Well, this is out of total episodes, so we haven't had guests on every single one. So,
Sure.
It's 24, and it's a pretty good balance between large retailers, so like Tractor Supply, At Home, Ulta, Best Buy, Neiman Marcus, etc. Also, some more kind of fast-growing, up-and-coming brands like Viore, Indochino, Fluid, My Teresa, The Citizenry, Hint, Voodoo Donuts, etc. And then we've had several CEOs of tech firms like Fabric, Happy Returns, New Store, Navar. So that's kind of interesting. And then the other one I looked at quickly was out of the top influencer list that Rethink Retail puts together. So I think that's approximately 100 people. How many top retail influencers, not counting the two of us, because we do happen to be on that list, other than ourselves, how many of the top 100 have been guests during our first 100 episodes?
Oh, I got to think at least 25, if not
Pretty
more.
good guess. It's 28.
Yeah.
So
28, there we go.
Yeah. So an interesting mix of retail leaders, influencers. We've also had some pretty high-profile folks like Seth Godin, Dan Pink, Brad Stone, Mitch Joel, Rashad Tabakawala. So I'm really just looking at that and say, it's amazing, really. When we got started, I didn't, particularly our first episode or first year, we didn't have that many guests on. And then just kind of how we've ratcheted us up to get, progressively higher level executives and some brands that frankly I didn't think would say yes, but here we are. So I'm very, very grateful for that. And stay tuned. We'll see what happens next season.
All right. Well, it's fantastic. So thank you again, particularly the listeners and all the guests, as you say. Our special guest on this episode is Al Sambar, General Manager at XRC Labs, venture capital firm and accelerator for the next generation of disruptors in the retail, technology, and consumer goods sectors. Steve, I believe you have some involvement already with XRC Labs, yeah?
Yeah, I got connected with Pano Anthos, who is the founder and I guess managing director of XRC a number of years ago. So I've known him and known XRC in various capacities. And I have known of Al because he was a partner at Kurt Salmon Associates, where a very good friend of mine worked as well. And I heard Michelle talk about Al on various occasions and say good things. And so I was very curious to meet him and very curious to get to learn a little bit more about how XRC works with startup and fast-growing firms.
And a little bit of behind the scenes inside baseball. We actually got together at a grocery shop back in Vegas, and a very rare technical issue happened, and the file was corrupted. So he was very generous and jumping back on the mic with us. So you'll hear a little bit more about that, and lots about retail from the VC firm perspective, which is super, super interesting. So stay tuned later in the show for that. let's jump right into the news of the week. So I thought we'd skip any kind of macro commentary. The economy is what it is. It almost feels at this time of the year, you just hold your breath and see how how it gets to the finish line, right? What's your observations been, and what are you hearing about what's going on in retail in these this Black Friday, Cyber Monday? As we said before, there's a lot of shopping to be done. What are you feeling is the more interesting storyline around this holiday season?
Well, there's a few things that are kind of interesting. Some people might know that we are, at least as we're recording this on Friday the 9th, we are in this dip period. There's typically 10 to 14 days after Black Friday or Cyber Week where traffic to websites and traffic to stores is down quite a bit from what it had been, and then it starts to really ramp up and kind of this sprint to the finish line, which makes it a little bit harder to read the tea leaves. I do think, as I've seen other reports that are coming out about how recent sales performance has been, as well as the whole Black Friday, Cyber Monday, it's looking, I think, more muted than some of the early reports. But again, we'll see because of different sample methodologies. And one just quick fact I thought was interesting, a story I saw the other day, was the degree of discounting during Cyber Week. So one report said that online prices were down, so in this inflationary environment, were down 1.9% year over year. And that's the largest year over year drop in 31 months. So, whether that speaks to this over inventory situation, whether this speaks to, hey, sales are slow, we better ratchet up the discounts, or just kind of hyper competitiveness, not sure. But I think some of the signs, I don't know if they're flashing red, but they're probably flashing yellow.
Well, as you know, I write a members-only report for Retail Council of Canada, so I get to interview dozens and dozens of CEOs. And I just finished the report this week, and the title of my report is "Canadians Play Discount Chicken with Retailers." So that idea that they're like, I think you got a better offer around the corner, I'm going to wait, but then eventually they're going to run out of real estate. I think the 17th, or what's the Saturday before the 25th, is going to be just a huge day, and we see similar things. We also talk about interesting things about the money is still in consumers' pockets. They're just looking for some value, an excuse to spend it, and this inevitable shift to experiences. I was talking to a friend in the airline industry. I'm not sure how many Canadians are going to be left here in February, March, because this will be the first time, we call them snowbirds. This will be the first time that Canadians, and many, have been able to go fairly comfortably to a warm weather destination. And that means, well, I guess if you're in any retail business that has anything to do with servicing a warm weather traveling customer, but it also means I'm not going to buy that big screen TV if I can only afford one thing. I'm going to Maui, I'm going to Florida, I'm going to wherever, right?
Yeah, I think absolutely we're seeing this shift, not just with Canadians to services, and travel in particular is really on fire. So if people are feeling stretched in their budget, they're going to make those trade-offs, and that might be to the disadvantage of products.
All right, well, let's take a visit to the Wobbly Unicorn Corner. We got lots of news in the corner. What say you of a bunch of results that came up, down, and sideways? Yeah,
it was a busy week, and I don't do this out of Schadenfreude, if people know that expression. But there was quite a bit of news of misfortune, I guess, or concerning actions on the part of several companies. So Stitch Fix, which is one of the older companies, so-called disruptor brands, they were among this later wave of disruption, and they reported a 21+% year over year sales decline, and their net loss, and they've been losing money for multiple quarters here now, went from a couple $1 million loss in the first quarter of 2022 to $60 million in the latest quarter. I went back, just because I love spending my time this way, apparently. But I went back, and 2 years ago, roughly, Stitch Fix was not only a unicorn, it was a deca unicorn, perhaps. I don't know if that's a real word, but it was their market value was close to $10 billion. Wow. A year ago, it was down to about $2 billion. And as of this morning, it was about $425 million. Rent the Runway also had a report, and this is a little bit better. I mean, their sales have been increasing pretty nicely. You know, they got hit very much by COVID because you're not renting gowns to go to events when they're not occurring.
Sure.
So they very much were hit especially hard by COVID. So they're on an upward trend. They did have their loss decrease from about $90 million last year to, I guess I can say, only $36 million. I mean, that's still like a 40% negative operating margin, something like that. So another one to talk about was something we touched on with the predictions recap, which was some of the issues in quick commerce. And not only, as we talked about last week, were we seeing valuations come down and layoffs and market exits and those kinds of things, but now we're seeing some consolidation. Getter is acquiring Gorillas, which was at one point apparently valued at about $3 billion. And so this will be a bit of a haircut down to maybe $1.7 billion. And they're also continuing to do layoffs. And so seeing like that space is really kind of getting a reworking.
Pretty quickly too.
Yeah. Yeah. Right. We can destroy the venture capitalist money in only 30 weeks instead of 30 minutes.
I describe it more as vaporizing, but that's a whole other.
On the little bit more positive side, perhaps Chewy, the pet supplies e-commerce company, they had really strong revenue growth from the year earlier, and which was actually a pickup from the trend they had been on, which I think is interesting because part of what seemed to really spike Chewy's performance was COVID, because not only did you have this shift to online players from physical retail, but also all the pets that got adopted. So
pandemic puppies.
Yeah. So now that we're, not completely beyond it, but not certainly the place we were a couple of years ago, to have their revenue growth accelerate this much is very positive. And they also managed to make some money. Not a lot, but they also managed to turn a profit after several quarters of losing money. So that's more positive. And the last one, though, hate to end with a more sad story, is Blue Apron. This is a company that also, kind of like the story with Stitch Fix, at one time when their stock went public, which is almost 5 years ago, their stock had a high of $60 a share. This morning, it was traded at 90 cents a share.
Jeez.
For those of you who can do math, that's about a 99% decrease in valuation. So this is a company that is now that was worth, a couple $1 billion maybe at one point, and is now worth about $25 million. It's looking like the total addressable market is, maybe 1/10 the size of what was thought when a lot of this investment happened. And the other problem is that they ended up acquiring, and this is something that Dan McCarthy, who's been on and really gets into, is really understanding the customer economics, and particularly in these subscription models, whether we're talking about Blue Apron or HelloFresh, they spent so much money acquiring customers, and then like 80% of those customers, the lifetime value was just not strong enough because they would unsubscribe after 10 weeks or something like that. So
they get bored of the menus or whatever, right? They'd say this is good, but
so you built this business and this marketing expense on the presumption that it was a way bigger market and it made sense. And one of the reasons why in my book and other places I've been so skeptical about many of these is because the valuations were just way out of whack with what I thought the potential could be, and the underlying cost of customer acquisition against customer lifetime value seemed really out of shape. And this is, like we talked about in the predictions, man, I think this is the thing that really finally became, after many of us pointing this out for 3 or 4 years, wondering, in this last year is when a lot of this has really come crashing down. So we'll see, what there's clearly going to be a shakeout, whether that shakeout occurs because, I think Blue Apron is, may not make it based upon what's transpired the last few months. So whether that is they go away and that helps the others get to better economics, or whether there's a merger or a bigger player acquires them, because there is a market for it. It's just it's much smaller, and the economics are proving to be extremely challenging.
Better news. Let's just wrap up. Better news we got a bunch of stuff to go through. Better news on the earnings front. We had some good news because we are also the good news podcast from a couple of big players.
Yeah, I guess this gets back, and maybe it's an obvious point, but even among economic pressures, there are still plenty of retailers that manage to deliver some good results, and that's because they have a remarkable value proposition and they execute it well. So just really quickly, Lululemon, they got punished a little bit by the stock market because of their inventory levels and kind of a cautious outlook, getting back to what we talked about kind of at the top of the news segment, but like 22% comp store sales growth. You don't hear numbers like that from a brand that is as big.
During COVID, they had a pretty big tailwind behind them because everybody was staying home. They were dressing less formally. That tailwind's kind of evaporated. So this is
right,
genuine
exactly.
growth.
Yeah, that's a little bit like what we were saying about Chewy. Like there's not so much that COVID comp, issue, and their operating margin 19%, which is very very high.
Let's end on Fanatics. So great business. People are literally fanatical about their business.
Apparently, yeah. This is a brand that I have to say I don't pay that much attention to, but they raised $700 million in new capital, which is pretty big capital raise
these days. Yeah,
which brought them to a valuation of $31 billion. We don't know very much about their revenues and profitability, and we know a little bit about their revenues, but whether or not they're making any money or not, we don't know as a private company. I was just kind of curious to see, what some other retailer valuations are, and there aren't that many retailers that are valued at north of $31 billion. Like I think, if you took Macy's, Kohl's, Dillard's, and Best Buy combined, maybe you don't get to $31 billion in valuation. So it's quite an impressive number. Whether that's sort of a function of this new money coming in and just kind of how venture capital works, we'll see. But they certainly are going to have to develop a lot of profitability to grow into that valuation. But they're definitely on a tear and growing very, very quickly, and obviously getting a lot of investor interest.
Hey, Steve, are you a Frank Sinatra fan by any chance?
Well, it turns out I am.
Well, start spreading the news. We're coming to town, strapping on vagabond shoes. I want to wake up in a city that never sleeps, king of the hill, top of the heap.
Well, that's right. We're actually heading to the NRF Big Show in New York in January. In addition to meeting with and interviewing our top retail leaders in the industry in the Market Dial booth podcasting studio, we will be on stage with Gretchen Gantz, Senior VP of Strategy and Analytics from the most remarkable Container Store. So see us live in person Monday, January 16th at 12:30 on Expo Level 3, Expo Stage 3 for Shift Happens, Choose Remarkable or Irrelevance, brought to you by Market Dial.
Welcome, or should I say welcome back to the Remarkable Retail Podcast. How are you doing this afternoon?
I'm doing great. Happy to join you guys.
Well, yeah, and for the listeners, they may say, well, I don't remember Al being on the podcast. Well, we had the opportunity to sit down, had a great interview at Grocery Shop back in Vegas, and the technical gremlins got in the way. We all sounded like a Mr. Roboto episode, so thank you for being so gracious to jump back on the microphone with us.
No problem, and December is always a fun time to talk retail. So
yeah, no kidding.
Timing works out anyways.
No kidding. Now, where are we reaching you today? I think you're on the West Coast, right?
I am West Coast, Northern California.
All right. Perfect. Well, listen, let's start. Let's take it from the top. Tell us about who you are and what you do for a living. Bit of your backstory.
I'm a general partner at a venture firm called XRC Labs. XRC Ventures is really multiple different funds, all focused on early stage consumer and retail. So early stage being anything from two entrepreneurs and a whiteboard that have an idea, all the way up to sort of Series A as writing first checks, and then maybe and follow on through like Series B.
Right. And tell us a bit more about your background. We got into that a bit. You've got consulting in your background and some other stuff, and you served in the military as well, where you learned lots of great leadership lessons. Talk a little bit about that.
Yeah, sure. Well, going way back in the 80s, I went to the Naval Academy, was a pilot in the Navy for several years, and got out of the Navy maybe after about 7 years when my first child was born, and then went into consulting and spent 25 years in consulting, doing strategy work, operational work, mostly all digital. I did it. I left the service and went into the business world maybe 2 years before the internet happened. So
right.
I got to spend about a dozen years just being a startup guy as all those businesses were starting up. And I did that ultimately until my firm was sold to Accenture in 2016 and sort of retired from consulting in 2020 to go full-time VC. As a VC, as a venture guy, started startup investing around 2007. I think I wrote my first check. And always as an angel, ran some small angel funds and member management funds, just angels investing together, had a lot of success. And then when I retired from consulting, just came over to XRC full time. I'd helped start up XRC with a fellow, with the CEO, is a fellow named Pano Anthos. We started it in 2015 or so. I think the idea was probably 2014. But the idea was that simply there was no fund at the time really focused on seed stage, early stage retail specifically. And that was both Pano and my background as investors. And I spent my whole career essentially consulting in that space.
So can you tell us a little bit more about, specifically about what XRC Labs is, what kinds of investments you focus on, and I guess just more broadly, how you sort out what's likely to work in the retail arena?
I mean, it's relatively, because we're early stage for any of your listeners that might hear VC, people tend to think, if you're not in it, you might think about it more broadly speaking, about any startup. But when you're in the early stage like we are, we're really looking for things that are disruptive, things that might take a few years to get to scale. So we're really looking for, our fundamental belief is that technology is changing how humans live their lives and how the businesses that serve humans will do it, right? So if you think about AI, you think about digital, it's an explosion of change. And we look for how that change will affect human beings as consumers, and where we think the way that they've always done things for the last hundreds of years is going to be completely changed. If a founder is right, well, then we'll bet on it. And we can bet on it with small amounts of money really early. And then as those companies prove themselves right, we can bet more money as they grow. That's essentially early stage VC in a nutshell. And we, since the partners at XRC have deep relationships with brands and retailers, and in fact, our LPs are some of them, right? It helps us when we find those, as those companies grow, we can help them scale into the industry and the distribution channels they need. So we just love the consumer space. It's been great for us. But we do look for early stage, trying to change how humans behave as consumers.
And I'm curious if you could maybe just touch on quickly, since you got started, like I've known, as I think you know, we talked about a little bit, I've known your firm and Pano really since the beginning. And I think going back then, not specific to XRC, but, sort of the venture capital world was very excited about these technology-driven consumer brands, this idea that stores were going away and retail could be like, a SaaS kind of business model that could scale very quickly. And I think that is a perspective that has changed. And I know you guys didn't play too much in that particular space. So I'm just kind of curious how the investment thesis perhaps behind XRC going back 6 or 7 years ago might have evolved, and maybe how you see it evolving in the future.
Yeah, that's funny, Steve. You might have some of our original decks. If you did, you might pull out one of, I think, Fund One. Our future of the stores was one of our investment topics, and we were a little counter there. I think everybody at the time was talking about retail apocalypse. We were talking about the transformation of the store. So we believed then and made investments that have worked out for us since then around the store as a service center, the store as an experience center, fulfillment center, that the store is the place that's closest to where the consumer lives. So we just never thought it would go away. We did think the economics of a store and the technology deployed in the store and the revenue produced from the store would be very different. So that probably hasn't changed. I think if you were to look at some of our earliest other themes, we thought there would be an explosion of new channels. So we were like in Shops, which was a live streaming shopping channel. It's still around, doing relatively well, actually. But it was live streaming off of social networks. It was pretty much the first one. And so we were big believers that there would be all these new channels for the consumer. That was pretty aggressive for us. That's really changed quite a bit. It's still true. You still have social commerce. It's been growing, and influencer commerce has been important. But direct-to-consumer brands, using that to be only direct-to-consumer, that's really changed. So we won pretty well on investing in the tech platforms that you will need to service these new channels, like video commerce and tagless commerce, things like that. But the idea of starting brands and VCs with VC venture capital, that's really changed.
So how do you, I guess, maybe give us a peek inside how you guys go about understanding innovation, which, is a very broad topic, but, things have been changing so quickly in so many ways for quite some time now. And obviously it's hard to predict the future, right? Nobody's got a crystal ball, but to be great at venture capital, to attract the investment funds that you do, you obviously have to have some sort of way of sorting through the hype, sorting through all the different founders that come your way. Can you give our audience any kind of glimpse into how you go through that process, how you kind of separate out the retail apocalypse type narratives, let's say, from some different narratives that might have more validity?
I think the other difference to keep in mind is we're early stage and we're sector specific consumer. So whether it's from Pano and myself or our LPs, part of our magic has to be being able to understand the trends that are happening in that domain space and which ones will have the best potential, and then being able to source the best founders for those potentially disruptive areas. So if I boil it all up, all my investors care about is I return a multiple on the invested capital, and it better be 5 to 7x, right? Like there's a lot of risk associated with venture investing, and people give me money because of the return, right? So we have to deliver that. We then turn around and look at the areas where we think there's most potential, that if this founder is correct, it will profoundly change an area that has a great value at the long end, right? That there's an addressable market, and it's that this founder's got the chops and the right IP and approach and team to go after it. And then we just we'll make small bets early and take great risk. I mean, we don't do as much. We're a little bit different on how we approach brands. But if you think about Billy Women's Razors, when they came to us, they were one of our early successes. Her single observation was just that, hey, women are being charged 30% more for the same blade that men need on razors. And she'd been turned down by all these other venture. So I remember them presenting, and I think it was Pano at the time said, why are you getting turned down? Why aren't other people wanting to invest in this? And they're all saying, well, basically, women isn't a good investable market. It's not an addressable market that's big enough. I think we gave her the task then to go to the nearest CVS, and we gave her a tape measure. It said, measure the shelf width of men's razors and then measure the shelf width of women's razors and come back and tell us a number. And the number was the same. Actually, it was slightly larger for women's. And we said, okay, well, I guess the addressable market is big. And we wrote the check. and it was fantastic for us. But so simply, it was a knowing enough to know that it's pretty easy to validate that there's an opportunity there. And it was easy to validate that women were being charged. There was a pink tax at the time. And we thought this founder was really sharp on building the market. And it was a way we could invest and support them as they grew. So that same philosophy is the same in 2015, looking at, women not getting the same pricing, getting discriminatory pricing, and that being endemic across retail. And then if I look at today, that same rationale exists in super techie topics like generative retail or generative AI generative content, which is so hot at the moment and really exploding. We could just, our job is to say, there's a great observation. How might it be applied? And is this the right founder to drive forward a business around this new thing that we could do that we couldn't do before? And today we still do the same thing. Look for the great founder with an idea that would really be disruptive if it works right.
Since you've been on the venture capital side as well as the corporate side, consulting side, I wonder if I guess a specific question was, we did meet at Grocery Shop, and I imagine you and your colleagues spend time at shows, but out more broadly in the market, kind of scouting for opportunities or perhaps trying to make sense of different things and synthesizing those. Do you have any advice on that kind of scouting, exploratory work for people that are working inside of more established businesses? Like, are there some venture capitalist type lessons that you think could be helpful to folks at bigger companies that are trying to create new innovations and find the next big thing?
Well, sure. I think CVC, corporate venture capital, and other types of approaches to funding innovation in large corporates. Generally, there's folks that are great at it and folks that are not, if we're honest about it. And how you do it for new brands versus how you might do it for a new technology is important. What is different for us than a corporate is we play much earlier than a typical corporate is allowed to do. Generally speaking, my startups, after we've had them for a couple years and now they're doing, say, 30 to 50 million of revenue, now a corporate could look at it because they could say, all right, if I buy that, I can turn it into something that's meaningful in my P&L. It could have a place to sit within my business groups. It's now at a point where it's got some EBITDA. Prior to that, it's really about growing the business and securing the IP and these other things that a corporate is, generally speaking, not as helpful for. So they tend to be making relationships with us to find out, which are the right startups and are they mature enough where they could look at them. And prior to that, they'll just want to pilot with them. So we have a lot of them that are LPs in us for that reason, because they can understand what we're investing, and half my value is being available for them on calls when they're asking about an area and which of the startups they should be piloting with, because they know I'm already looking at them from an investment point of view. But I do think the challenge for a corporate is, are they big enough to work with me? And I've got thousands of stores. I get that AI can do wonderful things, but is this particular startup able to support somebody as complex as my business? And that's a big filter for most of the corporates. I do think there are a few that have done a quite nice job of setting up, a separate area where they could go take a look at it and play with earlier startups. I also think there is a particular urgency in the moment right now where companies are willing, larger corporates are willing to come earlier than they ever have before. Right? I threw out 30 to 50 million, but you could see acquisitions of large corporates out there at companies that only have a couple million or 10 million in revenue. There's several of those in the last year. So that just 2 or 3 years ago, you wouldn't have seen corporates go that early. I think it's the AI in particular is just a couple really hot areas where if I can understand a technology and that I can keep it for myself and exclude it from competitors, or I can make it strategic for me, that you are seeing that's always existed in other, in like CPG, but it's not particularly been as prevalent in retail until recently.
Al, let's talk about the future. When we first talked to you, we were back at Grocery Shop and a little earlier in the year, and now we all turn our minds to 2023. You've already touched on a few trends. You just, speaking of kind of a new pattern of acquisition by large players that's new. But is there anything from either a technology perspective or a trend? We've got so many competing things happening. The economy may or may not slow down. Consumers may or may not buy stuff. They may go on vacation. They may or may not shop on interactive networks. I mean, what's on your mind for 2023? What's your lens when you kind of look ahead and say, I think this is going to happen, and I think the waves are going to push me this way or that way? What are you thinking about?
It's funny to even mention Grocery Shop. If you'd have told me in 2015 that I would be out at Grocery Shop looking for startups and meeting with startups, and I would have several of my startups making commercial deals there. That's really why we go to these conferences, to support our startups that are making commercial deals, and more importantly, to be there for the other startups that want to get into my platform or that I want to invest in. So that I would be at grocery would have been laughable. So I would point that out as an area where societal change, economic change has driven so much opportunity there. And a lot of technology change has made it really a great place to do some venture investing.
Interesting.
Because basically if you think about COVID and customers much more rapidly moving to click and collect and willingness to do self-check out, retailers actually deploying retail media networks, all of a sudden, this is a great area for really disruptive technology that probably, if you'd asked me 3 years ago, it would have been a pretty lousy area. And it's simply because COVID essentially accelerated a lot of things, and particularly in that industry. And you can almost look at the industries that have the lowest margins and are the most susceptible to these changes. And those are the places where technology can be a great investment. So I look at that. And if I look at forward to 23, I'm still equally excited about grocery, but I think that's just a small part of it. I think the middle, and we start first with these, what are the really big trends that don't change from year to year? Well, the U.S. middle class has less and less discretionary spend. The wealth gap is not going in the right direction and unlikely to flip very soon. So what are the technologies that might help serve that? And that is informed a whole bunch of things, like our investments in re-commerce and rental and all of these new ways where a consumer could live a life that they can provide for their family and stretch their dollar. And what are the technologies and retail things that will be important to help a consumer that doesn't have the kind of discretionary spend that their parents did or grandparents did. Same thing around health and the consumers being able to, purchase their own health outcomes, just like they might purchase groceries. Well, that you could see in my portfolio that consumer behavior around health and wellness has radically changed, and that's made a lot of opportunities. So we start at these really big things like sustainability and climate change, like brands not serving segments of the consumer, like BIPOC, and fundamental consumer behavior change driven by their household economics. And those then inform where these great opportunities are. And that those overlying theses are still right, and they're just accelerating.
So it's so interesting. I mean, I just got off the mic with some retailers, and we were talking about people and talent and acquisition and the role of technology. You can't. The debate in self-checkout was you're taking a job away from someone, for example, in the grocery world. Well, it's not the case. You can't find the people to do that work, and that's not seen by many as a short-term phenomenon. That's seen as a kind of a long-term. Not enough people to do a certain amount of jobs. So I'm sure that's attracting people's interest as well. Now, you mentioned earlier on about you've got your offering documents and it kind of lays out philosophies. Where can folks go to learn more about what you're thinking about and even get in touch with you and and perhaps even connect if they got a proposition or want to tap into your wisdom?
Well, we're still right there at xrclabs.com, and obviously we let our LPs have access to us and all manner of questions, but we're equally happy to take a call from somebody from industry. We actually do these things that we call them mini demo days. We don't even charge for them. I have retailers come to me and say, I'm really interested in a particular area or topic that's disruptive. It would be hard for me to imagine a retail or consumer area where I don't have a point of view and some portfolio companies, and we'll put them in front of the retailers' teams. We do it. I probably do several a quarter, where I'll bring 5 or 6 startups on a particular topic area, and those start with somebody reaching out to my email, Al at XRClabs.com, say, hey, I'm on retailer X. Can you do X, Y, and Z for me? Can you help me understand the space? And I'm always happy to take those calls. I mean, there's some selfishness in it, guys, because basically if my startups
it might be a buyer.
They get some business out of it, then it's at the end of it, it's going to be good for me too. So this is not just all, it's a little bit self-serving in that.
Well, we wouldn't know anything about self-serving action on this podcast or in our careers. But well, thanks so much for joining us, Al. It's first of all, it was great to finally meet you in person when I saw you in Las Vegas. But mostly, it was great to hear all your great perspectives and give us this different lens into this part of innovation that we often talk about on the podcast, but don't necessarily get to benefit from folks like yourself and firms like XRC. So thanks so much for joining us, and particularly your willingness to come back and do a redo with us. I really, really appreciate it, and hope you have a great holiday.
Thanks for having me, guys. I appreciate it, and I enjoyed it. Thanks a lot.
If you like what you heard, please follow us on Apple, Spotify, your favorite podcast platform, so you can catch up with all our great interviews, including Hal Lawton talking about Tractor Supply's remarkable Life Out Here growth story. New episodes of Season 5, presented by Market Dial, will show up each and every Tuesday. And be sure to tell your friends and colleagues in the retail industry all about us.
And I'm Steve Dennis, author of the best-selling book, Remarkable Retail: How to Win and Keep Customers in the Age of Disruption. You can learn more about me, my consulting, and keynote speaking at StephenPDennis.com.
And I'm Michael LeBlanc, consumer retail growth consultant, keynote speaker, and producer and host of a series of retail trade podcasts, including this one. You can learn even more about me on LinkedIn, and you can catch up with Steve and I in person at the NRF Big Show in New York, January 16th on the stage, talking about what it takes to be remarkable with Container Store SVP Gretchen Gans. See you in New York, everyone.